series where we're focusing on a family called the Greens, all 4 generations. And as, of course, with any family, there's drama. They're bold and beautiful. They're young and restless, and we're going to paint a portrait of their risk and continue to look at ways to protect the family and the family business. How will we do it? With insurance solutions tailored to meet their needs as they travel through the days of their lives. They all have just one life to live, but that life will be filled with glee at times and with passion at others. Through it all, though, and across the generations, they have a guiding light, a trusted team with you, their fee-only financial advisor, and LLIS, the advisor's insurance advisor. Each month's series will last about 50 minutes, and the narrators know that you're going to have burning questions, and because we're performing these in front of a live audience, feel free to be interactive and type in your questions, and we'll do our best to answer them as we go through the presentation. Today's episode is being recorded and will be posted to our website within a week in case you missed a pivotal moment in the story. And throughout 2015, our loyal fans will receive 10 CFP-CE credits, 1 for each month. The more you tune in, the more you know. Today we focus on children, insuring them for both life and disability, and we focus on special needs planning. In our family's case, it's for Cameron, the patriarch's grandson. Today's narrator constantly monitors the insurance and financial services industries to continue building the LLIS dynasty. He joined the LLIS cast in 2003 with his CFP and MBA, and he's been our executive producer as president and CEO since 2013. As the father of 2 young children himself, Mark speaks from experience today about insurance for and because of children. So now for the man who doesn't back away from tough conversations, here's Mark to help you with the toughest conversation, planning for children and special needs.
Thanks, Dina. Today we are going to continue talking about the Greens, and for our 2015 webinars, these are your clients. They're the Greens. So we're going to follow the 4 generations of them as they move through life with different financial needs as they seek to protect against uncertainties and deal with the upturns and downturns that get thrown at them. And so let's get to know them a little bit better. But what you missed last month, in July, Ben and Carl, they looked at life insurance because Ben and Carl are in the family business. And so we have key person coverage, salary continuation, buy-sell coverage. We also looked at disability insurance that covered a multi-life for Ben and Carl and a key employee. We also looked at key person disability coverage, business loan coverage, and buyout coverage. So let's look at the Green family tree. Andrew, the patriarch, up there at the very top, Barbara, the B's, the C's, and the D's. So as we go through the generations, we have the A's, the B's, the C's, and the D's. But Andrew's the patriarch this month, or the patriarch all the time, and so this month we're following Andrew and looking at what he's doing to plan for some of his grandkids and even great-grands. Why do we have insurance, particularly life insurance? It's to protect those you love. And in life, we work hard to make sure that we're protecting those that we love, like a spouse, partner, children, family members. We want to make sure that they're taken care of if something wasn't, if we weren't around to be able to provide the financial support that we're planning on. And then with special needs planning, it's even more so because there may be additional costs, additional things that need to be covered that we expect maybe at some point when our kids are 18, 21, grown, they're able to do to do for themselves or by themselves, and sometimes that need doesn't always go away just because of age. Speaking of age, many children today with special needs more and more are having normal life expectancies. There are 730,000 people in the United States under age 21 with autism. Now, autism is sort of a broad spectrum of severity, but most of the time, even sort of severe autism, children will have a normal life expectancy. But what that means is they may live a normal life expectancy but need care, protection, supervision, all of those things for a normal life expectancy. Individuals with Down syndrome have a life expectancy to age 60. When we did this, ran some of these numbers just a few years ago, the average life expectancy was 56. And so with medical advances just in a short period of time, gone from 56 to age 60. And so that's getting to be more of a quote-unquote normal life expectancy. But depending on what the needs are, what some of the issues that come up, children may require lifetime assistance. And when both parents are gone, assuming that parents have a normal life expectancy and their children have a longer or normal life expectancy, we assume that parents are going to outlive their children. And so what happens when both parents are gone, which if things go as planned, should be before what happens while the child is still alive and may still need care. So what do we do? Well, one option is that siblings will come in and be care providers, care coordinators. Well, there's a number of different things wrong with that. First, many times no one's ever asked the siblings, but siblings have a family of their own. They have their own occupations, families, children, and so without proper planning, that's just not necessarily a great plan. Do we want the state or the government to come in and take care of our children? I don't know that that's the best option either. Actually, I'm pretty sure it's not the best option. But what a good option is to consult with an attorney who specializes in special needs trusts. Here's sort of my disclaimer. I am not an attorney. I'm not an attorney who specializes in special needs trusts. This is a complex and can be a very intricate planning issue. And so what I'm going to talk about is more of big picture things and big picture issues and how to cover that with insurance, with insurance being the funding for all these different plans that we're setting up. And so over the course of the next 40 minutes now, I'm going to look at survivorship term, GUL, which is guaranteed or no lapse guarantee universal life coverage, GSUL, guaranteed survivorship, UL, or guaranteed second to die coverage, UL, which is universal life coverage, and NPP, which stands for the New Professionals Program, and that's a program for disability insurance that we're going to touch on. So Andrew talks to you, his trusted advisor, and is wanting to do some special needs planning for Cameron. And so you as the advisor go back in the recesses of your mind and say, well, over the last few years, I've had a couple situations where there was a special needs planning required. And so I remember Steve and Anna, I remember Jim and Janine, and I remember Mark and Laura, and there were some situations there. So let me go back in my mind and think about what we did with those. Well, what if there is a large exposure but not an indefinite need? There are second-to-die term policies available, and some of you may not even know that there is such an animal. But many times when we look at survivorship or second-to-die coverage, we're looking at things like estate tax planning or passing on a legacy to our heirs in the next 20, 30, 50, 60 years when I'm 95 or 102. But here we're going to talk about a situation where maybe there is still a large exposure. If mom and dad are both gone, then there are lots of expenses that are incurred to have someone besides the parent care for a child. But it unfortunately may not be an indefinite need. It may not be that 50 or 60 years. So Steve and Anna are both age 40, and they have a child, Patrick, with progeria. And with progeria, kids appear normal at birth, but by about age 3, they exhibit premature aging and are given a shortened life expectancy. And Steve and Anna each have individual term policies to replace each other's income. So they're both working. If something were to happen to Steve or to Anna, there would be that individual term coverage that would go to each other to make up for that spouse's lost income. But their concern really is what happens in the next few years if both parents are deceased. Even if Steve and Anna both got into looking at the picture, a boating accident here, they would have both life insurance policies that would do a lot of things. But for any of you who have children, you know that there are a lot of things you do for your kids for free that if you had to pay somebody else to do it, they would want a lot of money. I can think of several things that I've done for my kids recently where I can't imagine that I could probably pay somebody enough to do that. However, with special needs children, they may require full-time, around-the-clock care, things like that. So as parents, we just do those. It's just part of our life. To pay somebody to do it, it requires additional funds. So Steve and Anna worked with a special needs attorney to create a special needs trust. And they came up with that over on top of their individual life insurance policies, they really should have about another $1 million for all of those extra things. If something happens to Steve, Anna gets his life insurance, and Anna is still able to provide care for Patrick. But if they're both gone, costs of full-time care really jump. And so they'd need another $1 million on top of that, those two individual policies. And so because, unfortunately, we have a shortened life expectancy, we use a survivorship term policy or second-to-die term policy. And depending on Patrick's life expectancy, children with progeria typically live to about 13 years old. Some live into their 20s. And so we could look at a $1 million second-to-die term policy for 20 years for only $685 a year. That's very inexpensive for that much coverage, but it's a very short period of time. The chances of something happening to Steve and Anna within the next 20 years are very slim, assuming they're relatively healthy and no other underwriting issues. Even a 30-year second-to-die term policy for $1 million, $13.25 a year. Again, very, very inexpensive coverage. Probably costs more to get the trust drawn up than the sum of the premiums for many years, but important to do to have that trust as well. And what if things change? What if there are medical advancements that change the life experience for Patrick and children with progeria? Remember, I just said that for Down syndrome children, life expectancy has changed from 56 to 60 in just the period of time that we looked at our statistics here, and it wasn't that long ago. So medical advancements can change a lot of different things for children or especially children with special needs. So this term policy is actually convertible to a permanent survivorship policy when the level term period ends. And so just like a traditional term policy that you can convert the term to permanent coverage without any new underwriting, that works the same way for the survivorship term policy. So when we get to the end of the 20 years or 30 years, if things have changed and maybe we still need the coverage, but Patrick's life expectancy, Patrick's lived more than the 20 or 30 years, able to keep that policy going. So it's it's inexpensive coverage now for the short term, but if things change, the policy can change too. Well, and the second type of policy we're going to talk about is a guaranteed UL. And you as the advisor remember your second set of clients, Jim and Janine. And Jim and Janine are looking to fund a special needs trust for Adam, who's 15 and he has autism. And they are looking to fund permanent life insurance to put in a trust. And recently they've inherited some money, and because they've been the beneficiary of these policies, they want to use some of that to be towards their son, and so they want to put about $50,000 from their savings in this recent inheritance into these policies to fund this so that Adam will be taken care of for as long as he's alive. And additionally, they're looking to use about $1,500 combined in monthly premiums to fund these policies. And they had arrived at these numbers sort of before the advisor and I started working together, but they'd already spoken to an agent who came up with sort of this idea for them, and so we looked sort of at the nuts and bolts and said, is there anything better we can do? But part of it was correct. With the special needs trust, we want to emphasize the death benefit as opposed to something like a participating whole life policy where you're going to build lots of cash values. The money inside the trust really can't be accessed for the most part, and so what you want to use is to have a lot of death benefit there when the time comes, so that then the trust is funded for, in this case, Adam when mom or dad is gone. So Jim and Janine had been shown 2 individual no-lapse UL policies. And I mentioned this before, the GUL, or no-lapse GUL, stands for no-lapse guarantee universal life policies. And so as long as a particular premium is paid, these policies are guaranteed for the insured's lifetime. Maybe sort of like similar to a lifetime term policy, as long as X premiums are paid, in this case, $400,000 for each Jim and Janine by using a $60,000 lump sum. And this was part of why the client and the advisor started looking around, because they said they really wanted to commit $50,000 and were being told $60,000 was the minimum. And this $1,493 premium for the next 7 years. And so that was sort of what they'd earmarked as far as premium, and the $400,000 each seemed like a good amount to them. So the advisor asked us to take a look and see how did that compare to other things out there. Well, using a low load, the Advisor Plus No Lapse Guarantee UL, for Jim, he has a $400,000 policy approved at standard rates for a lump sum premium of $28,000 and $713 a month for 7 years. And Janine's policy, quoted at standard rates for a $400,000 policy, had a $22,000 lump sum, so the lump sum in total $50,000, and $559 a month for the next 7 years. Good news, Janine was approved at a preferred rate class, so her premium went down to $530 a month. And so we were able to get them the right lump sum that they were looking for, the $50,000, and a combined monthly premium of $1,243. So what were we able to do? Well, first off, save them about $10,000, or save them $10,000 in the initial lump sum, 28 for Jim and 22 for Janine. But because of the design of the low load policy, they're also saving an additional $21,000 over the next 7 years in the monthly premiums. So saving over $30,000 a year for the same $400,000 of coverage each for a no-lapse guarantee UL policy that will be in the trust and will be there at Jim's death and Janine's death to provide funds to help fund their son's care and any sort of supervision he might need. And so that was the second set of clients that you pulled back from the recesses of your mind. And then you thought, well, there was another set of clients, and they were Mark and Laura. And Mark and Laura had two SULs, or survivorship UL policies. Survivorship, or second to die, means that there is a death benefit paid at the second death, not at just the first death. And so you thought that this might be a better template for what we're trying to do here for Andrew and Barbara. And Mark and Laura had two survivorship policies owned by a trust. And it had been set up a number of years ago, and recently they started looking at these policies and realized that the son and daughter are both listed as trustees. Well, that causes some problems. Robin is in college. She's doing fine. It's okay if she's a trustee. But their son has a condition called Prader-Willi, where he needs supervision so that he doesn't eat too much and actually cause organ damage. So he's been needing care for many years. And they'd been on a wait list for over 2 years to get state aid and assistance for some of the care that he needs. But the problem is that if he is a trustee of this policy and is also a trust beneficiary, it is possible that he could have what's called constructive receipt, or basically the look of him being able to take money out of this trust for his own use, which would create basically an income or asset pool that would knock him out of the state aid and being eligible for all of those benefits. And so what happened? Well, Mark and Laura got a new attorney, and they got a new ILIT, because they did not want this ILIT and the way it was set up now to knock their son out of being able to get benefits. So they contacted an attorney, had a new survivorship, guaranteed survivorship UL policy, applied for it, had it issued inside of a new irrevocable life insurance trust that was drawn up with an attorney who had experience in estate planning as well as special needs planning. At the same time, because of the way the trustees were written on the other trust, they needed to dissolve or get rid of the existing trusts and the policies inside of there. And so what they decided to do was, in order to be fair to both of their children, they surrendered the old policies and had the cash values distributed to the daughter as one of the beneficiaries of the trust. And so she's going to be able to use that money to help pay for college, put a down payment on a house. So they were excited to be able to do that for her. At the same time, have the new life insurance policy inside of the new ILIT and protecting their son so that he can now will be able to receive the state aid without any issues because of the cash values or the assets in that what we now consider sort of a defective trust, but not an intentionally defective trust. And so as Andrew's advisor said, okay, all right, that Mark and Laura situation, that seems like the one that we're going to sort of concentrate on here. So let's look at our parties that we're looking at right now. We have Cameron, Barbara, and Andrew. And Andrew being the grandfather, he's the one with the money. He wants to look at the best way to provide for Cameron. Again, first thing Andrew needs to do is consult a special needs attorney. And the attorney is probably going to recommend to set up a trust. That's just common. It's probably the starting place for a lot of these situations. But then they also need to fund the trust. And there's lots of ways of doing that, but one of the best ways to do it without putting $1 million into the policy today is to do a $1 million life insurance policy. And so what kind of insurance do we do? Well, should we put the life insurance on Barbara? That's one option. We do know that Barbara is the primary caregiver. She's the coordinator. She's basically in charge. She's in charge of Cameron and all of his care. So it might make sense that when she's gone, we need money to be able to provide and coordinate that care. Plus, everybody loves Mom. You know, just makes sense. Mom's like a big warm hug, and so we want to make sure that she's insured. We know from previous webinars, and any of you who saw it remember that she's a standard rate class. And so to get new coverage, $1 million life insurance policy on Barbara would be in the order somewhere of $15,000 to $16,000 a year. And so that's our starting place. And you as the advisor remembered, okay, well, that works. But I remember that when we had the policy on Mark and Laura, because there were two people and it was a second to die policy, our premiums were actually lower. And so you talked about it with the attorney and thought, well, does it make sense to have the policy on Andrew and Barbara? And the light bulb goes off, and you say, yes. Let's look at $1 million second to die policy on Andrew and Barbara, right? Well, if Andrew dies first, with him being the grandfather is sort of the natural order of things, sort of the circle of life, we assume that he's going to die first. And because it's a second to die policy, there's still no death benefit until Barbara's death. So basically the exact same place if we had an individual policy. She remains Cameron's caregiver. When there's two people gone on a second to die policy, the person is still living. It's like an individual policy on him or her. So in that case, if Andrew predeceases Barbara, which we sort of expect, then everything's the same as having the policy just on Barbara. Well, what if Barbara predeceases Andrew? Well, there's still no death benefit until his death. But if something were to happen to Barbara, Andrew has said he will become the primary caregiver, become the primary coordinator for Cameron's care. So there's still a reason to have the coverage on Andrew. In life, he's helping to pay for some of the care and some of the expenses. But if Barbara wasn't there, Andrew would be in charge of the care, and at his death, then there would be the money in the trust to help provide that care as well. And they're both standard rates. We know Barbara is standard, and we're going to say that Andrew's standard non-smoker. Now, what are these annual premiums? Well, we're covering two people, so we would think it might be less, but Andrew's quite a bit older than Barbara. Premiums are still 11,000, mid-11s to mid-13s for $1 million life insurance policy. The first one was just on Barbara for $15,000 to $16,000, almost $17,000, that would pay at Barbara's death. On the second to die policy, it's a much lower premium and will pay at the second death of either Barbara or Andrew. And it's actually 25% less by insuring two people for the same $1 million death benefit if we cover Andrew and Barbara instead of just Andrew. And so we have this with the second to die policy, even though he's quite a bit older, by insuring two people instead of one, the premiums are lower. And so on the off chance that Andrew outlives Barbara, there's money there. But assuming that Andrew does outlive Barbara, which again is the normal, is what we would expect, the death benefit is going to come at Barbara's death either way, but for a much lower premium. So they decided to set up the special needs trust and fund it with the survivorship life insurance policy. They both had to go through underwriting, do all of that, but importantly, they called the attorney and they set up the special needs trust, and then they funded it with the life insurance. So there's really a couple steps. You have to have the trust, you have to have all that set up, and then the trust needs to own the policy. We've seen or heard of situations where people set up a trust and then forget to put life insurance in it, so there's a trust with no assets. Or they may set up a life insurance policy and forget to put it in a trust, and so the death benefit goes into mom and dad's estate rather than into the trust, which is what the intent was. And not all special needs are immediately evident. There's a recent statistic that says autism diagnoses, and autism diagnosis on average is no earlier than age 4. And so there are points in time where we are going to have issues known right away or very, very close to birth. Other times it may not be an evident or a known thing for many years. And then there are issues that we're born with, and then there are issues that may be bad choices. And so, again, sometimes by looking at things when children are very, very young, before they can, in this case, before they can make bad choices, may be able to do things to help protect children. And so what I'm going to talk about next is life insurance on children. So we're going to talk about insuring children. And I think the best way, I remember hearing a speaker one time that said the most memorable things that you'll ever hear somebody talk about are things that have happened to them. So a real story about really what they have done or things that have happened to them. And so I'm using what I've done personally to insure my children's lives. I have 2 children, a 5- and 7-year-old, and they each have a $100,000 no-load universal life insurance policy. And so I'm going to explain why. Well, it could provide for health care costs. And again, this is, as the presentation is called, is having the hard conversations. These are not places that you want to think about as you're falling asleep at night. It's the kind of things that keep you up if you happen to start thinking about it. So, but money doesn't solve problems, but in some situations it can pay for things. In every situation it pays for things, but can help with situations. So in this case, the $100,000 may provide for health care costs. I can only imagine the kind of health care bills that would happen if a child has a prolonged illness or needs a lot of care. So there would be that death benefit that would come in there. What about lost income? I'm not talking about my 5- or 7-year-old's lost income. They aren't child movie stars. I'm talking about mine. Again, in those places you don't want to think about it at night, I don't know how long it would be before I could come back to work if something happened to one of my kids. And so that death benefit would help pay the bills for a period of time. And then future, let's fast forward to not that. What about when they're in college or getting a mortgage and you have to co-sign a loan. I'm sure every one of you, when I said co-signing a loan for your children, shuddered and collectively freaked out. But people still do it, and I'm going to take every one of your advice that I felt come through the internet and not do that for my kids. At the same time, people do it. And so, that is a situation where a life insurance policy, if you co-sign on a loan and a child dies before they're able to pay off the mortgage or pay off a student loan, that comes in handy. And lastly, final expenses. Funerals are expensive, and even not for fancy things. The average cost is somewhere between $7,000 and $10,000. This is not extravagant. This is sort of just the cost to get in the door. And so at an already difficult and emotional time, the life insurance helps pay for these expenses without having to decide on where do I get money, how do I pay for this, that, the other. So it helps pay for these financial hardships without further stress. Now, the other thing it does is with life insurance on small children, without any known health issues, it's pretty streamlined underwriting. And so you're able to get coverage on children at a young age, and it also protects their future insurability. And so Andrew wanted to get these policies on all of his great-grands. And so we're going to look specifically at Diana down there on the bottom left. So Andrew got this policy for Diana when she was 2, and no known health issues at that point. And then 2 years later, she was diagnosed with juvenile diabetes. And juvenile diabetes is not, people can live relatively normal life expectancies, but it makes life insurance very difficult and expensive to get later on. But in this case, we already had this policy on Diana. And so there are ways you can use this coverage to protect their future insurability. In this case, we're going to use the premiums, going to pay a higher premium to force growth in the policy. So when the policy was set up when she was 2, Andrew was paying $20 a month. And at $20 a month, it was going to have some cash values, build some cash values, and about age 65, it was going to hit what's called the corridor. And that means that the IRS says you must have X amount of life insurance for Y amount of cash values at Z age. And so at 65, you couldn't have a $99,000 cash value and a $100,000 policy. Has to be much a smaller ratio. And so for the $20 a month, it was projected that at age 65, she was going to have about $105,000 of death benefit, and it was going to keep growing a little bit after that. But in 2 years after the diagnosis of juvenile diabetes, they started to increase the premiums to $108 per month, and that's sort of the maximum that the policy could take. And instead of having a growing death benefit at age 65, the cash value starts increasing, and so it hits that corridor much faster. And so at age 13, the policy is starting to have a growing death benefit. So much so that by age 65, it was projected that she'd have about $703,000 of death benefit. So really, having that policy early on means she can keep it. And then with the universal life and the flexibility that it provides, being able to increase the funding to sort of force the policy to grow is valuable, and something that you really couldn't have done with a term policy. Sometimes we see where advisors or clients are asking about term on children. It's not. I think the permanent policy and the ability to do things just like that is much more valuable than the term policy, and the premiums really aren't all that much different because the costs of insurance on a child are relatively small. And what are some other benefits? UL is a flexible premium. So If something happened, I needed to skip premiums, stop premiums for a year, you can do that. You can't do that with term. And like I just looked at for Diana, we could accelerate the premiums. So there's a few options. One, I could stop paying premiums for a little while. Two, I could ramp them up and cause that, force that increase in death benefit, or just overpay it for the first 10 years or 18 years of their lives and then not pay it anymore. Could this life insurance coverage help them get dates? Probably not, but I don't know. You may be able to meet somebody and say, hey, I've got a nice car and I've got a life insurance policy. It may just work. I've heard of weirder things. And the last thing we're going to touch on, moving away from the life insurance, is disability coverage and the NPP, or New Professionals Program. Sort of like my UL or the life insurance policies insuring children, not all planning for children involves special needs. A few years ago, I had an advisor contact me and say, I'd like to get disability insurance for my son. And I hadn't heard that before, and so we started talking, and his thoughts and process and everything that he'd looked through was his son was, I think, in his early 20s, just had his first job, was sort of off mom and dad's payroll, was fine, didn't have a spouse, and their concern was they looked at all of their financial planning and they said, all of our plans work fine as long as it's just me and my wife. But he said, if something happened where my son had to come back and live with us, and again, without a spouse, without other plans, he would probably come back home to live with us, and then we're paying for him. We're not going to kick him out or leave him out on the street. But then I might have to work more years. My wife might have to work more. We may not be able to travel like we wanted. And so this concern of if he wasn't able to work was going to really derail their retirement plans. And so his goal was to help his son get a disability policy, and he was going to sweeten the pot a little bit, sort of like Andrew does. And Andrew understands the disability risks. He doesn't want to be an insurance company any more than this advisor wanted to be an insurance company to pay for care, to be a healthcare provider. And so when we look at children who are, it's hard to call them children because now they're grown, but they're out of college, they have that first job. They are much more likely to become disabled than die. And when you're disabled, you have more expenses. When you die, really, there's no expenses. There's a loss of income, but you don't have additional expenses. When you're disabled, you're still there, but still have all these other costs associated. And in the last 20 years, disabilities have dramatically increased. And deaths due to the big three, cancer, heart attack, or stroke, are down significantly. So what does that mean? It means the three things that used to kill you now disable you. And so this is what Andrew's looking at when he starts having these conversations. And so Andrew is willing to pay for the first year of a disability policy for his kids, even his grandkids, as they get those first jobs, so that it's one thing that he doesn't have to worry about and gets them set up, gets them started on the right path. So after this presentation, I hope that all of you will be down with NPP. Now, Tony isn't Andrew's biological son. He's his grandson-in-law. Is that the right thing? Yeah, grandson-in-law. Well, Tony was a 26-year-old engineer when he married Claire, and he got a job with an engineering firm. And Andrew remembered you as his trusty advisor saying, you know what, there may be a program for that to help him get that disability coverage that you'd really like him to have. And the New Professionals Program is that program. And depending on the degree, the occupation, there are particular students who may be eligible for coverage, like doctor students who are getting their medical degrees, vets, dentists, engineers, attorneys. So a number of different specific degrees for young professionals who are starting out, may not have a high income yet, but based on a track record of their advanced degree, specialized schooling, and history of income increases, they can take these take this first-time job, starting job, and over the course of time turn it into what's normally a very well-paid career. And so for the New Professionals Program, there are certain occupations for, in this case, children who are eligible. Their actual income isn't considered. They may not be making very much as that medical resident, but when they start getting that first job, their income goes up by 10 times. And so they aren't looking at their income now. They're basing it off of some amount of $4,000, $5,000 a month, a specified amount based on their particular occupation. Group coverage isn't considered. And so it's a benefit to these young, new professionals who are starting out and are able to get up to $5,000 or $6,000 a month without looking at their current income and without their group coverage. And they may be able to start off with a graded premium, or like the coins here, sort of a stair-stepped. It's the same coverage, full benefits, but may start off at a much lower premium, a graded premium that increases every year while their income is low and starting off. But then as time goes on, the premiums increase while their income increases, or in the case of clients like physicians that may not make a whole lot of money for a few years and then get that first job, and they go from $60,000 to $300,000 in one day, can say, okay, I want to stop the increases. Let's put that on a level premium now. So Tony, our first-year engineer, was able to get a $3,000 monthly benefit policy under the New Professionals Program. Had $6,000 a month of future increase options, had a residual rider that would pay in partial, in the case of partial disability, a COLA rider that would pay him a monthly increase after he's been on claim for 12 months and every year thereafter, and a catastrophic benefit rider that would be an additional $3,000 a month on top of the base $3,000 per month in benefits in sort of the worst case scenarios of disability. That level premium, $861 a year. So for a full policy, that's pretty inexpensive. But I talked about that graded premium. The graded premium for the exact same policy starts off at an even lower $495 a year. And so they have that, the new professionals have the ability to look at that lower premium. Next year it will be 500 and some odd dollars. The next year it might be higher fives or low sixes. But his income should increase every year, and so either he absorbs those increases, or after a few years he starts making quite a bit more, and we lock in a level premium at that point in time. School with, besides a degree and a futon and a mismatched set of dishes that he'd picked up a whole bunch of different places, was a student loan debt. And Tony decided to be, thought he was going to be an engineer, took classes for 2 years, realized that, whoops, he wants to be an electrical engineer, not a choo-choo train engineer. So he had a $47,000 student loan debt and then had to go back a second time for the right engineer. And so he has almost $100,000 in student loan debt. Nothing like a dentist with $200,000. But these are what many students are coming out of, have when they're coming out of school. They have their first job, which maybe isn't all that, it's exciting, but it may not be all that well paid, but have a huge student loan debt. There's $1.16 trillion in outstanding student loans right now. And the loans that are 90 days or more overdue rose by 11% in 2015. So it's no surprise that this is a big worry. A recent study of millennials showed that student loan debt is their #1 financial concern. And when you see these numbers, that's no surprise, because it's over $1 trillion. That, I don't know how many zeros that is. I could probably think about it, but that's a lot of money. And 90 days overdue, that means they owe a lot of money and they're behind on their loans. And nobody likes to be behind on anything. So this is a big source of worry for many millennials. And I need to look up who said there's an app for that. Well, insurance companies like to come out with, hey, we've got a policy for that. So they've actually created a student loan protection rider or standalone policy that will be able to, if you become disabled, pay off your student loan. And 36% consider student loans their biggest financial concern. So the student loan protection rider can cover up to $1,000 per month if disabled, almost up to $2,000 if they have an advanced degree. It's a 10 to 15 year benefit period that, in the event of a disability, pays the student loan directly. And it's paid directly to the loan holder while you're disabled. And so this is how we can add this as a secondary benefit on top of the base monthly benefits. Most of the time when we run into issues with monthly benefits and how much someone qualifies for, it's because that money is going into their pocket and they can use it to pay for bread, milk, boat payments, whatever it might be. And so anytime we try to add benefits that go into someone's pocket, insurance companies are worried about, well, if they become disabled, are they really hurting or really that bad off if they become disabled? In this case, because the benefits would go directly to the student loan provider, it's helping out with their financial situation, but they don't really feel it. I mean, it's not an additional $500 or $1,000 per month in their pocket they could spend and not pay off the student loan. So it's a neat rider that allows a little more protection for clients with the student loan protection. And so it's designed as that 10 to 15 year solution to cover the time when clients are at maximum exposure, because as they come out of school, their income is usually the lowest and that debt is the highest. And so as time goes on, their income rises, they're paying off the debt, and so that 10 to 15 year time period is when we move from a point in time where 1 year after graduation, 30% of income is usually being applied to paying off loans. 10 years after graduation, it's closer to 10% of income. And so that's why that 10 to 15 year protection. So we look at Tony again, and we have an $800 per month benefit for him for 10 years. And so that covers $96,000 of his $100,000 student loan. Cost $37 per year. When I see numbers like that, it's surprising that banks and student loan lenders don't require people to get this kind of coverage to be able to pay them back for $37 a year. And with the new professionals program, because of those FIO, that FIO rider, or future increase rider, he can use this policy to increase his benefits even if his health changes. Now, for those of you who have been following really, really closely, Tony is actually a self-employed IT consultant today. What's so neat about individual disability policies is that even though he got that policy a few years ago when he was an engineer, that policy stays with him. It's an individual policy. It follows him wherever he goes, whether he's an engineer electrical or an engineer choo-choo or a self-employed IT consultant who just decides not to even get dressed most days and writes code in his boxers. That policy is with him wherever he goes. The policy may not want to be there when he's in his boxers, but the policy is still there. And so getting that coverage when he's has that occupation, when he's employed, he can take that policy with him even when things change. So we covered 3 different options when we're looking at planning for special needs children. But of course, some of the tough conversations aren't just about special needs children. It can involve planning for children, and I shared a little bit about what I've done for my own. And the new professionals program, we love our children. We love them while they're in our house, and then I think we love them when we get them out of the house and don't want them to come back. I imagine that's what's going to happen. I still have many years. We want them to come back to visit. We want them to be self-sufficient and be able to spread their wings and fly and be out on their own. So that was our presentation for this month about the greens. And a few quick things. Did you know that we have dates for our low-load insurance services Insurance Academy here in Tampa, February 4th next year. It's going to be at the Sheraton Riverwalk. We're really excited about it. It's a new location. Tampa has spent millions of dollars revitalizing the downtown and Riverwalk area, and it's going to be a lot of fun. So come walk the walk with us. Registration is now open on our website. For those of you who are going to be in Charlotte, come see me and Jerry. Oh, there it is right there. See me and Jerry at the XY Planning Network, their first ever conference here just next month. And for those of you who may be new to LLIS, what are the top 10 things that make LLIS different? And for some of you XY people, think of this like Letterman, but many of you XYPN people might not know who Letterman is. But some of the top 10 things that make us different, one is the free monthly webinars, like the one you just listened to. And we have 4 more through the rest of the year. We aren't your competition. Our only clients are fee-only advisors. We are insurance people. We are not fee-only advisors. And so we work with you to find the best fits for your clients. We save you time and your clients money. We do a lot of pre-underwriting to avoid surprises in the application process. We provide a lot of advisor tools and client tools on our LLIS.com website. We are a proud sponsor of many fee-only financial planning groups. And you'll see myself, Jerry, some of you saw Keith Maurer here recently at the Garrett Planning Network conference. And so we are proud to sponsor all of you, and thank you for all of you who come talk to us when we're at the conferences. We have product specialists in life, disability, long-term care, annuities, and the hybrid long-term care life and long-term care annuity policies. We keep you and your clients in the loop with our AIM system, or our application information message emails. And we help manage your clients' policies now and in the future with our proprietary APE and note systems, the advanced premium email and the notification of term expiration that lets your clients know their term policies are coming to the end. Are they looking to convert it to permanent coverage, add new coverage, or hopefully the policy's done exactly what it was supposed to do and they sail off into the sunset on their brand new boat. And if anyone has any questions, I'd be happy to take them at this time. If you'd like to type them in, or at this point, then I will see you all next month, or yes, I'll see many of you next month at the XYPN conference or on our next LLIS monthly webinar. So thank you, everybody.